The US government has a plan to never pay back its debt, and it's been working for over 50 years. Somewhere in Washington tonight, a Treasury official is preparing to auction off billions more in new bonds and calling it Tuesday. That's not a crisis unfolding, it's the plan working exactly as designed. The number attached to that plan is $38 trillion, larger than the combined economies of China, Japan, Germany, and the United Kingdom. Relative to its own economy, the country now owes more than it did at the financial peak of the Second World War. Economists have a polite name for what happens next: rolling over the debt. We're going to call it the rollover treadmill instead, a system where new borrowing exists only to repay borrowing that's already due, and the total never actually shrinks. The easy explanation is that America is broke, headed for the kind of bankruptcy that swallows an over-leveraged business. Except a government that borrows in the currency it prints doesn't go bankrupt that way. It does something stranger, and this is the story of the one number that will decide how it ends. Not the $38 trillion, not the 115.8%, but the interest rate the market demands to keep buying. So today we're asking 4 questions. First, how big is this debt really? Second, how has a government that never plans to repay it kept this running for over 50 years? Third, who actually pays the bill hiding inside all that borrowing? And finally, what breaks first if the world's patience runs out before Washington's borrowing does, the question Washington refuses to answer out loud. This isn't an abstract accounting puzzle. Net interest on the federal debt is projected to exceed $1 trillion a year starting around fiscal year 2026, according to the Congressional Budget Office, a bill that now rivals the entire U.S. defense budget. That's money competing directly with schools, infrastructure, and whatever the next downturn requires. It's happening while inflation has climbed from 1.8% in 2019 to 2.95% in 2024, according to the World Bank, a 63% relative jump that quietly erodes the real value of every dollar owed. If the US never intends to repay this the traditional way, the honest question isn't when it gets paid off. It's what default would even mean for a country that prints its own currency. Hold that question. For now, understand this: the debt itself isn't the emergency. The moment refinancing stops being cheap, that's the emergency, and nobody's agreed on when it arrives. Start with the number everyone's heard and almost nobody can picture. US federal debt, held by the public plus intergovernmental holdings, sits at roughly $38 trillion as of late 2025, according to the US Treasury's Fiscal Data Service. Set that against the economy carrying it. US GDP reached approximately $30.77 trillion in 2025, according to the World Bank. The debt is bigger than the GDP that's supposed to service it. Now look at the ratio, because the ratio tells the real story. US government debt sat at 100.2% of GDP in 2019. The exact year-by-year path varies by source, but the ratio climbed sharply during the pandemic before easing back, somewhat settling at 115.8% in 2024, according to the World Bank, a general government measure for that year distinct from the $38 trillion Treasury figure quoted earlier, which covers total federal debt as of late 2025 and isn't directly comparable to this ratio. That's a 15% increase over 5 years, even after the post-pandemic pullback. The line never went back to where it started. It just found a higher floor. For context, at the financial peak of the Second World War, US debt to GDP topped out near 106%. Today's 115.8% is higher than that. The country currently owes more relative to its own economy than it did while fighting a two-front world war. There was no war this time. Just arithmetic. Put the raw figure beside other economies and it gets stranger. At $38 trillion, US federal debt now exceeds the combined GDP of China, Japan, Germany, and the United Kingdom, 4 of the world's largest economies added together. One country's IOU outweighs 4 countries' entire annual output. The rating agencies have noticed. S&P pulled the US off its top AAA rating in 2011. Fitch followed in 2023. Moody's, the last holdout, stripped its own AAA rating that same year, citing rising debt and rising interest costs as reported by CNBC. 3 agencies, 3 downgrades, 1 direction of travel. That is not an accident. So yes, this is big by every measure available: dollars, share of GDP, historical comparison, or the opinion of the people paid to grade this risk. But big isn't the dangerous part of this story. The dangerous part is what the government does with debt this size instead of paying it off. The debt got this big because of a simple mechanism. And it stayed this big because of something rarer: 50 years of unbroken creditor trust in a currency the world still wants. The Treasury doesn't write a check each year to retire old debt. It issues new debt to cover the old debt as it matures, adds a bit more to cover the current deficit, and auctions the whole package to whoever will buy. That's the rollover treadmill in motion, new borrowing standing in for repayment indefinitely by design. It's worked because someone always shows up to buy, and that willingness, creditor trust in the dollar, is the real reason this hasn't collapsed the way a normal borrower would. The Federal Reserve held about $4.2 trillion of Treasury securities as of late 2025, down from a 2022 peak near $5.8 trillion according to Federal Reserve data. Even that reduced holding alone still exceeds the entire annual output of a country the size of the United Kingdom. Foreign governments buy in too. Japan and China together held roughly $2 trillion in treasuries as of 2024 according to the US Treasury's TIC data, though that's a shrinking share of total foreign holdings compared to a decade ago. Fewer buyers as a share of the whole. Worth remembering. Picture a household that never pays down its credit card. It just opens a new card every month to cover the old one's minimum payment and keeps getting approved because the bank trusts the paycheck behind it. The balance never falls. It just moves to a new lender with a new due date. That's not a metaphor for collapse. It's a working description of how Treasury auctions have functioned since at least 1970. The US has run a budget deficit in every year but 4 since then, financing nearly the entire shortfall through new issuance rather than repayment, according to CBO's historical budget data. The catch is the cost of staying enrolled in that system. Net interest payments are projected to cross $1 trillion annually starting around fiscal year 2026, according to the CBO, a figure that now rivals the entire defense budget. If interest keeps climbing while growth doesn't keep pace, what does it start crowding out? Education, infrastructure, the next emergency response. We'll get to that. Is this a Ponzi scheme then? Structurally, it rhymes. New lenders effectively funding old lenders with no underlying repayment. But there's one real difference. A Ponzi scheme collapses the instant new money stops arriving because its promised returns were never real. Treasury bonds pay a modest, government-backed return in the world's dominant reserve currency. That distinction, real backing, paid out in the world's dominant reserve currency instead of fake returns funded by the next sucker, is the entire reason creditor trust has held for 50 years instead of collapsing like every private fraud eventually does. Whether that trust and currency advantage can run forever is a different question, and it's now being tested. Here's the figure that actually decides how long the treadmill keeps running. Not $38 trillion, not 115.8%, but the interest rate the market demands to keep buying. That number just started moving. What it means for everything above is next. Picture that household from a moment ago, the one rolling its credit card balance forward every month. Now imagine the interest alone costs more each year than the entire grocery bill. That's roughly Washington's position, scaled up, because somebody pays for $1 trillion in annual interest. It doesn't vanish. Right now, it's being paid 3 ways at once, and none of them show up as a line item on a receipt. The first is inflation. US inflation rose from 1.8% in 2019 to 2.95% in 2024, according to the World Bank, a 63% relative increase. Inflation doesn't cancel debt, but it quietly shrinks the real value of what's owed. Every dollar the Treasury repays in 2026 buys less than it would have in 2019. That's not a scandal. It's a feature. It's also a tax nobody voted for, paid by anyone holding cash or fixed income. The second is distributional. The top 10% of US earners captured 30.7% of national income in 2024, according to the World Bank. Economists studying who eventually absorbs the cost of fiscal adjustment, future tax increases, benefit cuts, or both, keep landing on the same uncomfortable point. The group best positioned to absorb that adjustment is also the group holding most of the assets that benefit from today's borrowing. The bill hasn't arrived yet. Someone's already on the guest list. The third is opportunity cost, and this answers the crowding out question from a moment ago. A $1 trillion interest bill, growing every year, rates stay elevated, competes directly against every other category of federal spending. It doesn't need to overtake defense or Medicare outright to matter. It only needs to keep growing faster than the economy funding it, and on current CBO trajectories, that's exactly what it does. And yet, the economy paying for all this isn't visibly staggering. Unemployment sits at 4.2% in 2025, near historic lows according to the World Bank and the Bureau of Labor Statistics. Growth, inflation, and joblessness all look survivable in isolation. Nothing about walking down a street in 2025 America feels like a debt crisis, which is exactly how a slow-moving one keeps moving unnoticed. So what actually breaks first? Not repayment. Nobody's planning to repay this the traditional way. What breaks is the cost of staying on the treadmill. The CBO projects federal debt held by the public will reach roughly 172% of GDP by 2054 under current law, bigger, relative to the economy, than anything in US history, wars included. Growth is already softening. US GDP growth eased to approximately 1.5% in the second quarter of the most recent reporting period, according to Reuters' coverage of Bureau of Economic Analysis data, even as inflation stayed elevated. A shrinking growth rate has to support a widening debt load. The math does not close on its own. The market is starting to price its patience. Reuters bond market coverage shows 10-year and 30-year Treasury yields pushing higher in recent trading, a sign investors want more compensation to hold US debt over the long run. Foreign appetite is thinning too. Japan and China's roughly $2 trillion combined stake is a shrinking share of total foreign holdings compared to a decade ago. Fewer buyers, higher required yields, lower growth, a debt load still climbing. None of these facts alone is fatal. Together, they describe a government whose refinancing gets pricier exactly when it can least afford that. This is the answer to the earlier question about default. A country borrowing in its own printed currency doesn't default the way Argentina or Greece did. It defaults quietly, through an interest bill that swallows more of the budget each year through inflation that erodes real returns, until lenders demand a premium just to show up through downgrade after downgrade until borrowing costs simply reflect the risk everyone already suspected. Not a missed payment. A shrinking margin for error, year after year, until something gives. It would be easy to end there and leave the picture that dark. But the full record has a second half. US debt-to-GDP fell from that Second World War era peak of roughly under 6% down to around 23% by the mid-1970s, according to Treasury historical data, driven almost entirely by sustained growth outrunning the debt, not by austerity or default. Japan, meanwhile, currently carries a debt-to-GDP ratio near 255%, according to the World Bank and IMF, more than double America's, and keeps refinancing it without a market crisis, largely because most of that debt sits with domestic, not foreign, creditors. Germany, by contrast, sits at just 62%, proof the ratio itself isn't destiny, policy, and growth move it in either direction. The lesson isn't that America's debt is fine. It's that the outcome isn't fixed yet. Growth outrunning debt worked once. Domestic ownership has kept Japan's version of this treadmill running for decades without revolt. Neither path requires repayment the way most people imagine it. Both require what the US currently has less of than it used to: sustained growth and buyers willing to hold the debt without demanding a bigger premium every quarter. So, where does this go? On the numbers in front of us, the debt itself isn't the immediate danger. The US has run this treadmill for over 50 years and can plausibly keep running it. The real constraint was never Washington's intent. It's the market's patience priced daily in Treasury yields, and that patience has no guarantee attached. Watch the interest rate the market demands, not the size of the debt. If it keeps climbing while growth stays soft, that's the tell. If growth firms up or global demand for dollars holds, that same $38 trillion becomes far more manageable than the headline suggests. One of those two paths is currently winning. Keep watching the yield, not the debt. Thanks for watching. Mind your reserves. This video is for educational purposes only and is not financial advice.